presentation.
Good morning, traders, and a very warm welcome to this presentation on the Relative Strength Index, or more commonly known as the RSI. Those new to FP Markets webinars, my name is Aaron Hill, and I'm one of the market analysts here at FP Markets. As always, I want to thank everyone for taking the time out of their busy schedule to be here today, and I hope you're able to take something away from the following presentation. Okay guys, before we get things rolling, please do me a quick favor and let me know the audio is all good and we can all see the welcome slide. Excellent, thanks guys, much appreciated. Excellent. Okay, for those interested, a recording of this webinar will be available through either the FP Markets website or on FPM's YouTube channel. Our support team will also email attendees with instructions on how to view the recording shortly after the webinar concludes. Okay, I know it's a bit of a drag, but just bear with me while I quickly run through the disclaimer on screen. So the content within this presentation is intended for general advice only, and none of it should be relied upon as personal investment advice. FP Markets, as you may have already read, do not take into account your investment objectives, financial situation, or particular needs. FP Markets has also made every effort to ensure the accuracy of the information as at the date of publication. Look guys, the disclaimer's job is ultimately to inform us all here that anything discussed or presented is not investment advice, and you should always do your own research in anything trading and investing. Okay, now with that out of the way, let's switch to the session's topics. As I mentioned briefly at the beginning, the presentation's focus is on the Relative Strength Index, so the RSI indicator. Can I quickly ask how many of us here actually use the RSI in their trading or have at least looked at the indicator before? Wow, okay. So I know it's popular, so I'm assuming quite a few of us have at least added it to our analysis. Yeah, okay, right, okay, quite a few of us use the RSI, fantastic. Look, given the RSI boasts a number of key functions, I have an absolute truckload of content to get through today, as I ultimately, as in every presentation, want newer traders present here today to walk away a shall we say, more informed trader regarding the RSI. With that, first on the scale, I'll be briefly discussing the RSI and highlighting its calculation. Guys, don't panic. I am far from being a mathematician and have purposely kept the formula as basic as possible. Next in the queue, we have defining current trends with the RSI indicator. Yeah, and then we'll be taking a look at the different methods used traders use the RSI. Let me get my words out correctly. So I'll be looking at the various RSI methods that traders use in their trading, which, as you can see on the slide, includes defining current trends with the RSI, pinpointing overbought and oversold signals, which is, you know, guys, which is simply financial jargon to describe price extremes that show the security traded has gone too far in a particular direction. We'll then look at RSI Divergence Signals. This is an interesting one and a common application of in the technical community. We'll next be looking at something called RSI Failure Swings. which, as far as I've seen, are not commonly discussed, though are worthy of attention. Excuse me, guys, just 1 second. Guys, just to confirm, can you see my my screen welcome slide, my agenda on the screen? Give me a second, guys. I really apologise. Oh wow. Okay, 1 second, guys. I'm not sure what's gone wrong there. How about now, guys? Okay, I'm not sure what happened there. Thank you. Yeah, apologies, guys. Sorry. Yeah, so what I was discussing previously was literally the agenda. So what I've already said is literally on this bullet point slide. So yeah, again, apologies, guys. I'm not sure what happened there. Just give me 2 seconds. So look, I'll just quickly run over it just once more. So look, first on the scale, we're going to be talking about the relative strength index, and I'll be defining the RSI and highlighting the formula. We'll then look at the various methods RSI traders use the RSI for. So defining current trends with the RSI, overbought and oversold signals, RSI divergence signals, failure swings. And we'll then summarize the presentation and emphasize the RSI indicator as a confirmation tool. Then finally, as usual, the floor will be open to any questions related to the content. Newer traders are especially encouraged to get involved at this point and ask questions. Remember, look, guys, there are no silly questions here, as we all have to start somewhere, right? I can remember it vividly. There's so much information out there that needs to be taken on board. So yeah, please do step forward at this point if you feel you're not clear on anything shown in the presentation. I just want to check if there's any more questions regarding these slides. It looks like we're all okay. All right. So without further ado, let's jump into the first slide. And you'll have to excuse the drawing. I'm clearly not known for my artistic abilities. So look, right, the relative strength index, or for short, the RSI, was designed by a chap who goes by the name of J. Wells Wilder. Wilder actually features the RSI in his 1978 book, New Concepts in Technical Trading Systems. I've actually read this book, and for any interested here, Wilder begins talking about the RSI, concept from about page 60, if memory serves me correctly. Despite being developed over 4 decades ago, the RSI has clearly, shall we say, stood the test of time and remains one of the most popular technical indicators today. So at its core, the RSI is a momentum oscillator, which, according to Wilder, measures the velocity of directional price movement, shown by way of a value that oscillates between 0 and 100. So the basic framework of the indicator consists of an x-axis, which represents the time scale, and to the right we have what's known as the y-axis, which represents the magnitude or distance the indicator has moved. We also have notable levels marked at 70, 30, and as well as 50. More on the uses of these levels in a little bit. Now, a reading above 70, as shown on the slide, is considered overbought, and moves below 30 are viewed as oversold. Again, guys, more on that in a little bit. Now, think about momentum as the speed of price change. For example, if we have a handful of traders buying into a market and price advances, more traders are going to see this movement and likely trade. Consider, momentum-based strategies in particular. And before you know it, we have a reasonably strong wave of bullish activity. Excuse me, guys, just 1 second. Yeah, as I said, before you know it, we have a strong wave of bullish moves. So the question most traders and investors ask is how long will the market remain in this state? So are buyers going to run out of fuel or overheat, so to speak? So price cannot continuously rise, right? Also, as momentum turns lower and the market sells off, it often tends to over-deliver on the downside. So another way to think about all of this is markets are often, as I'm sure most here are aware, often overreact to good and bad news, right? This is where the RSI can be a handy tool to have in your arsenal to help decipher this movement. Generally, the RSI is thought of as a leading indicator. A leading indicator, essentially provides a signal before a trend or reversal occurs. However, I've also seen some traders refer to the RSI as a coincident indicator, which essentially means it works almost in real time, providing information about the current situation on that particular chart. Personally, I feel the RSI is more leading than anything else, but that's just my opinion. So, with all of that, what I've just covered, for me, a basic definition of the RSI is it's an indicator in place. Sorry, guys, about the outside noise. I apologize for that. So, look, a basic definition of the RSI is an indicator in place to measure momentum in a particular security, be it stocks, commodities, or even foreign exchange, for example. While the basic reason that if gains were significantly greater than losses over the period, then the stock was considered overbought, and if losses significantly exceeded gains, then it was oversold. Obviously, do not confuse this with relative strength, which is it's a different animal entirely. So for anyone interested, the most common means of establishing relative strength, this is not the relative strength index, the most common means of establishing relative strength is through something called the ratio method. In other words, it's a ratio between two instruments to see which one is outperforming the other. So look, the key point of this presentation is to understand that the relative strength index measures the momentum in one market on any time frame. Therefore, traders who prefer lower time frames, so think scalpers and day traders, can use this indicator, and also swing traders as well as position traders can also use this indicator on the higher time frames. Now, it's important to note that the default period for the indicator is 14, as set out by Wilder himself. But traders do adjust these parameters to suit their trading style. A lower period, as you can probably imagine, will increase the indicator's sensitivity, and a higher period will reduce the sensitivity. Guys, this will all hopefully make more sense as we dive into the RSI methods. Let me just see if I have any questions before going forward. No? Okay, excellent. Okay, now for those interested in the mathematics behind the indicator, let's take a quick peek at the calculation. Now, it essentially provides you a number between 0 and 100. So how is this value calculated? As I said at the beginning, I will try to simplify this as much as possible, as I assume most of us here are not really interested in the maths, and essentially most will assume if they see the RSI value on their charting packages that the number has already been calculated correctly. So look, guys, here's the rather grim looking formula, which is essentially 100 minus 100 divided by 1 plus the RS, which is relative strength. So the relative strength, the RS, is the average of all up moves over the last 14 periods and the average of all down moves in the last 14 periods. To get the average, we simply sum the moves and divide by 14. Once this is done, we can then divide the average of the up moves by the down moves to give us the relative strength of that market. We then add this value to 1, and then divide this by 100. This value is then taken from 100 to give us the RSI value. So look, guys, a quick example. So assume the average gain is 0.24 and the average loss is 0.1. Dividing these values gives us an RSI value of 2.4. We then add 1 to this value to give 3.4. Following this, we simply divide this by 100 to give us approximately 29.41. And then we take this value from 100 to give an RSI value of around 70.59. However, guys, I can tell you firsthand, I would wholeheartedly recommend using Excel to compute this formula, this calculation, as it will give more precise figures. Now, with that out of the way, if you're going to use this indicator regularly, you'll need to hone in on the various methods used by professional traders. So look, excuse me, guys, 1 second. Okay. So the first thing we have to look at is defining a trend or current movement, shall we say. Personally, and for this, I will use the same slide as we used before to help demonstrate this. So look, personally, for the RSI, I know of 2 ways to help define a trend. The first is a bullish or bearish 50 centerline cross, and secondly, by using bullish or bearish failure swings, which I will touch on later. Again, you'll have to excuse my artistic interpretation here, but here goes. So look, so a rising centerline cross, which means the RSI value crosses above the 50 line in the direction of, excuse me, guys, sorry, in the direction of the 70 overbought threshold, which indicates trend is increasing in strength. Essentially a bullish signal until the RSI approaches the 70 overbought. This, if you think about it, informs us the average. So this, like, if price crosses above the 50 center line, essentially a bullish center line cross, it informs us the average gain is larger than the average loss. So momentum is definitely to the upside. Excuse me, guys, just 1 second. So on the next part of it, we're going to be looking at, oh, excuse me, guys, I'm lost at the moment. Just give me a second. Sorry about this. Okay, sorry about that, guys. So look, a falling centerline crossover is, on the other hand, takes the shape when the RSI value falls below the 50 center line in the direction of the 30 threshold, and which indicates the trend is weakening and is seen as a bearish signal. This, of course, informs us that the average loss is greater than the average gain. Look, guys, really, that's all there is to it for the bullish and bearish centerline cross. I'll just check if I have any questions. Nope. Excellent. So I assume you all understand this this approach. Fantastic. So next up we have, I believe, what's known as the RSI overbought and oversold signals. I've kept a similar slide format as this, as I believe drawn examples help show what I'm trying to demonstrate without the distractions of a real-time price chart. However, we will get to the charts shortly. So RSI overbought, quite simply, is when the RSI value climbs above the 70 mark. This is considered an overbought environment. Conversely, movement into the 30 threshold is considered oversold. One second, guys. Look, so Wilder in his book actually refers to overbought and oversold as just tops and bottoms. However, I've also seen this movement referred to as also overvalued for overbought and undervalued for oversold. So for me personally, I simply see overbought and oversold as warning signs. So an RSI value within overbought, within this area here, tells me that longs might not be the best move at the moment. I emphasize the word might here. So look, a key point to note is the RSI tends to top and bottom out prior to price action, providing an indication that a reversal could be on the cards, or at least a reaction. And these tops and bottoms form within the overbought and oversold areas, which are shaded in blue. So think of these areas, you know, as zones where buyers and sellers show exhaustion, or when upside and downside momentum dries up. Another key point to be aware of when looking at overbought and oversold signals is that although, yes, we do have an oversold signal when price crosses into 30, but and an oversold signal when we cross into 70. But this can be difficult to use in trading, as if the market is. So I'm so sorry about the sound outside, guys. I'm not sure if you can hear that, but it's really quite annoying. So look, as I said, it can be difficult. The RSI can be difficult in trending environments, or begins to trend out of a range. The RSI can, in that case, remain in overbought and oversold space for a prolonged period, potentially causing a number of false signals, right? So as many traders will be looking to short the market when the RSI value is in overbought, for example. And if it remains within this area, this could be problematic if the value remains within this area. So how do we, as traders and investors, combat this? Well, some traders look for the RSI value to actually form a peak and bottom. Just give me 1 second, guys. There we go. Well, some traders look for, as I said, look for the RSI to actually form a peak and bottom, or bottom and exit overbought and oversold ranges. This can then be looked upon as a bearish or bullish cues. We can look at this from the viewpoint that an RSI that's peaked within overbought, for example, and exited its range is showing us that the currency pair, if we're trading FX, that is losing momentum following an up move. Guys, it is said that the RSI functions best in ranging environments. You know, while I would agree with this, the RSI can still be used in trending markets as well, as I'm sure some of you guys already understand, but more on this in a little bit. So moving forward, next in line we have what's known as the RSI divergences. Well, Wilder actually stated in his book that the divergence signal is the most indicative characteristic of the RSI. So divergence, I'm just trying to think of the best way I can explain this. So divergence is formed when price movement and the RSI indicator diverge, essentially moving in opposite directions, if you will, which can provide a healthy cue that the cue of a market turning point. So divergence is essentially a signal that the current trend on the charts traded, that is, has lost momentum. It is the opposite of a confirmation signal, which is when the indicator and price are moving in a similar direction. So look, momentum the speed of price change, as I'm sure most of you know, is helpful in assessing trend strength. The RSI, however, does a reasonably good job in telling traders when the trend or decisive movement is slowing. Though through either the centerline cross, as we've briefly discussed, as well as the overbought and oversold signals, and as we're looking at now, divergence moves. So this lessening of momentum, of course, can be difficult to decipher on shall we say, a naked chart, so no indicators. This can be especially difficult for newer traders. However, it's critical to know that less momentum, as measured by the RSI, does not always translate to a reversal, but it does signal something is changing. This could mean the market's action is taking a breather, so consolidating before the next leg up in an uptrend, for example. Okay, look, enough of this. Let's shift the attention to the diagram on screen. To help solidify our understanding, I thought it would be a good idea to show common divergences in drawn form first, and then underline the practice on a couple of charts. As you can see, there are 4 common divergences newer traders must be aware of. We have bullish and bearish regular divergences, and we also have what's known as hidden bullish and bearish divergences. Although this diagram may seem somewhat complicated, I hope in a few minutes that will not be the case. So regular divergences shown on the upper panel of the diagram show when a possible reversal could be in the offing. As you can see, a regular bullish divergence takes the shape when the RSI forms a higher low. Higher low that corresponds with a lower low in the price movement. So a bearish divergence, a bearish regular divergence that is, occurs when the RSI creates a lower high and the price movement creates a higher high. So look for hidden bullish divergence. We'll be looking at the lower panel. We can see that price makes a higher low in terms of the hidden, as I said, hidden bullish divergence, with the RSI indicator following through with a lower low. Conversely, a bearish hidden divergence signal consists of a higher low, a lower high in price movement, which corresponds with a higher high with the RSI indicator. So look, this is a really important distinction to make. For hidden divergences, I have mostly seen these form as continuation signals within a trend. And if you remember, I just mentioned regular divergences show when possible reversals form. Okay, so that's an important distinction to take away. Hidden divergences generally form continuation signals within a trend, and regular divergences form reversals of that trend. So now, something I always look for when using the RSI indicator is divergence signals to form within or very near oversold and overbought space. For me, it just makes sense. However, especially with hidden divergences, sometimes this is just not possible. So really, what regular divergence is showing us is when momentum is losing steam, shall we say. Price could be in the beginnings of forming a reversal. Hidden divergence essentially occurs when the price trend holds up. So as we can see on the diagram here, hidden divergence occurs when the trend holds up despite momentum going against it, shown by way of the RSI. This echoes strength in price and offers a continuation signal within, as I said, the prevailing trend. Okay, look, it's important to keep in mind, as I've said, that regular divergences are possible signals for trend reversals, while hidden divergences are signal trend continuation. So just click over to the next slide, guys. So next up, we have the chart of the euro-dollar daily time frame, showing regular bullish and bearish divergences. I hope this chart is clear for everyone present. One of the attendees in my previous webinar asked if I could fill the slides with the charts I use to make them easier to see. A very good idea, so thanks for that. So regular bullish and bearish divergence on the euro-dollar daily time frame. We have 3 instances of regular bearish divergence and 1 instance of regular bullish divergence. As you can see, with the regular bullish divergence, price forms a lower low. However, the RSI indicator forms a higher low. Excuse me. We touch gloves with the oversold region, form a high, come back lower, and form a higher low, as depicted by this blue line here. This shows that upward momentum is potentially gaining to the upside, and in this case, it did work out, and we crossed through the 50 center line, which, as you already know, is an indication that the strength is increasing to the upside. Now, here we have, as I've said, 3 examples of bearish divergence, a regular bearish divergence, I should say. We can see that price formed higher highs on each occasion. Oh, not that one. Maybe. Oh, yes, it did. Price formed higher highs on each occasion, though the RSI follows through to the downside and formed what's known as lower highs and lower highs. This shows that momentum is clearly losing stamina, and we could see as I said, a reversal or a potential reaction. In this case, in these 2 cases here, we saw a minor reaction, but in this case, it was a reasonably healthy trend. I wouldn't really say a trend signal, but it was a healthy correction that formed here. And just to round off, let me just click over to another chart, I believe, of the euro-dollar daily time frame, except this time with hidden bullish and bearish divergence. As you can see, these are, as I said, hidden divergences are sometimes difficult, in my experience anyway, to find within overbought and oversold regions, but did form, in this case, form what you would call trend continuation signals. So, as we can see from the chart, we had a higher low, excuse me, form here, followed up with a higher high, followed up with a subsequent higher low, which corresponded with a lower low on the RSI indicator, giving us a potential trend continuation signal around this location here. We also have this is a bullish variation, by the way, and we also, across the chart, we have what's known as a bearish hidden divergence signal, which, as you can see, price action forms a lower high, which is corresponding with an RSI higher high signal, giving us a trend continuation, a possible trend continuation cue at this point here. All right, so let me just check if I've got any questions going for. We have a few questions, guys. I'm going to get to the questions at the end, if that's all right, because this might distract me from what I'm doing. I've got the failure swings to click onto, and yeah, let me just get the failure swings out of the way, and I'll head over to the questions if that's okay. All right, so bullish and bearish failure swings, which, according to Wilder in his book, are very strong indications of a market reversal. As I briefly said at the beginning of the presentation, these formations, as far as I've seen, are rarely used, and if they are used, they're used incorrectly. People mark, for some reason, some traders mark the previous low as the as the fail point, where it just doesn't make any sense if in that case, and it's an incorrect signal. Right, so failure swings are independent of price action, focusing solely on the the RSI for signals, and it ignores the concept of divergences. So as shown on the slide, and just to be clear, the source of these images are from a site called Investopedia, which perfectly demonstrate the framework of failure swings. So first up, we have a bullish failure swing, a bottom. A bullish failure swing forms when the RSI moves below 30, oversold, so that's an oversold signal, pulls back and holds above, holds above 30, so forms a high. So this is what's called a fail point. We return and we form a retracement and bottom around this point. What's important here is we don't cross back below the 30 threshold. So we have a low that I'm just trying to think of the best way I can explain this without confusing anyone. So the RSI value enters oversold, the oversold range, pops back above it, exits the oversold range, forms a higher, and then subsequently forms a higher low, which does not exceed the recent low point here. The fail point is drawn from this high here, and that's drawn across. Once the RSI value crosses above this region, this is considered a buy signal according to the rules of engagement. Okay, and then we have the failure swing, which is a top formation. It's exactly the same as the bottom formation. It's simply a mirror. It's simply reversed on its head. So the RSI drives into the overbought region, peaks, subsequently falls to a low point. This doesn't necessarily have to be at 60, but it generally falls around this region. Hits 60, forms a subsequent lower high, and then again falls lower and breaks what's known as the fail point and the failure swing point. So this is when you know you have a failure swing in hand, and this is when many traders consider this as a bearish signal. So look, think of these formations as the potential beginnings of a trend which form before price action. So this slide is interesting, guys. It's the same chart, or it's the same euro-dollar chart we've been using on the daily time frame. Now, the bullish divergence shown here, which we went over recently, followed up with a bullish failure swing. As you can see here, price nudged into the oversold range, formed a high, followed through with a subsequent higher low, and then rallied past the failure swing point here to give us our bullish failure swing. Now, so this essentially, let me find my cursor. What this essentially did, this bullish failure swing, is confirm the bullish, this is a bullish regular divergence, confirm the bullish regular divergence, help confirm, should I say. In fact, this is a method that some traders adopt, as I've said, namely to wait for the divergence to begin forming and then wait for the movement to be confirmed, as I've said, by a bullish or bearish failure swing. We also had a bullish failure swing form at this point here. I hope you guys can see this. Now, this is where a lot of traders incorrectly mark up the failure swing points. A lot of traders would select this swing low here, which is incorrect. So we peak within the overbought range, fall lower, form a low, and then subsequently form another a higher low. A lower high, excuse me guys, a lower high. And I'm not sure, no, I did check, I don't think this, remember guys, one of the important points is with a failure swing, it can't re-enter the overbought range, and in this case it didn't. I remember checking this, it didn't actually enter the overbought range. It came very close, but didn't. Anyway, so this is the fail swing point here from this low here. So we draw this across, and once price pings below that, we have a potential sell signal in hand. This again helps confirm the bearish divergence seen at this point here. As you can see, the bearish divergence is confirmed by the bearish failure swing and bullish failure swing here actually have produced sizable reactions in comparison to these reactions here, which, as far as I can see, did not provide bearish failure swings in this point. So this is something you guys should really consider looking at as a way of confirming the divergence signals that you see. Okay, look, now we've seen the various ways in which traders interpret the RSI. I thought it would be a good idea, good to round off how we can use the RSI in trading. I will start off by saying that, and this is just my opinion, using the RSI in isolation is not really something I would recommend. What I mean by this, for example, is entering a market after the indicator registers overbought or even exits overbought for that matter. The same goes for the other methods shown here today, including divergences. So how do we use this in our trading? So look, for me, guys, it's one word: confirmation. We can use it to help confirm other technical tools. Of course, the technical tools used by traders will vary. For me, I'm a huge fan of price action and have been for years. So I do use in my analysis, I use the RSI to confirm price action levels. Now, to briefly show what I mean, again, we're going to be using the euro-dollar daily time frame. As you can see, through the price action, we have a trend line support here, a traditional trend line support, which is a year-long trend line support, which converged with the RSI regular bullish divergence and the failure swing point. So what we have here is our trend line support, and it was the RSI helped confirm its validity as a potential reversal zone. And last but not least, let me just throw over one more slide. I think I have. Yes. This is another trend line example, but slightly different, and this may confuse some newer traders that are just focused on the traditional trend line supports and resistances. What we have here is a trend line support turned resistance. So as you can see, price, we bottom at this point, we hit the trend line here, we hit the trend line here again, this is support, but then we follow through with a break, which was subsequently retested as resistance. Now at that point, we're in a potential trend, right? We've broken the trend line support. And do you remember that within this webinar, within the presentation, I said that the hidden bearish divergences and hidden bullish divergences are generally thought of as continuation signals. And that is the case here. We have an RSI hidden bearish signal, a hidden bearish divergence, confirming the trend line support turned resistance at this point here. So look, guys, I really hope you can see the RSI offers traders, the use RSI offers traders as a confirmation tool. Right, let me just switch things over to the Q&A section and see what questions we have. Just quickly before I do want to highlight that the RSI can also display actual support and resistance levels and trend lines as well. These support and resistance lines can come in the form of, as I said, horizontal zones or trend lines, and can help forecast price movement. Look, guys, before I take on any questions, I can spin things over to the live charts and demonstrate this quickly if needed. Let me just check the questions. Guys, would you like me to spin over to the live charts and just show this in action? The RSI showing the patterns, showing some potential patterns that forecast price movement. You just ping over yes or no, or I can get on to the questions. I don't see any. Okay, excellent. All right, no worries. I'll ping over now. Just give me 2 seconds, guys. Right, I do hope you guys can see my slide because I know we've been having problems with the slides. Okay, so look, we're on the RSI, we're on the euro dollar daily time, my analysis charts for FP markets. As you can see, we've already discussed on the euro dollar on the daily time frame, and we had the RSI bullish failure swing with regular bullish divergence. And if you notice on this chart, something I didn't highlight on these slides was as we formed the bullish failure swing at this point here, we also crossed above the 200-day simple moving average. Now, this is not a webinar on moving averages, I know, but if you cross above a price cross above or below a simple moving average, can indicate a potential price trend. So with the trend line support we had marked on the previous slide, alongside the 200-day simple moving average price break, alongside further confirmation from the RSI bullish divergence and bullish failure swing, we have some reasonably serious confluence going on at this point here. Hence, the price rising from this area should not have really surprised, to be honest. On the H1 chart, very recently, we had a trendline support break, which indicated that momentum could be heading lower. But as I've pointed out here, we also had RSI support around this area here, which did, albeit not perfectly, help stop downside movement. Let me just switch over to a couple more charts, see what I've got going on. So I'm just trying to find a good example for you guys. That was probably the better one there. Let's go on to the H1. Okay, look, so the H1, we have what's known as an RSI resistance area. As you can see, price, the value or the indicator on a number of occasions has capped upside attempts, right? And it could potentially do that again if we test this area. So what I've noted in my recent analysis, and you can look at that on the FP Markets Traders Hub, is this area actually converges with this price trend line resistance. As you can see, price is drawn from this peak to this peak, incorporates all these peaks here, and then joins with the 109 level. And also, for anyone that has the simple moving averages applied to their charts, I also have the 100-period moving average applied to the H1 chart here. And this also converges in this area. So if price tests this area, I would expect sellers to potentially, make a show, given the confluence with the RSI resistance area and the technical confluence here. But there was also the point of H1 resistance at 108.99 and daily supply, the lower side of daily supply at 109.18. So we still have some particularly enticing confluence around this region. Right, guys, I'm going to spin things back over to the charts as time is, the slides, as time is of the essence right now. I assume you guys can see the welcome slide. I'm just going to double check. Yeah, but I believe you can. Okay, right, I'll just spin over to the questions. Right, so we have a question. Wouldn't a 30 and 70 be best for entry triggers? There's a question. This is the question. I'm not too sure what that means. Wouldn't a 30 and 70 be best for entry triggers? Now, if you mean the RSI, actually, let me just ping back to the chart so it'll be easier for me to show. If you mean the 30 and 70, you're referring to the oversold and overbought. Some traders do use it for entry triggers, of course. But I would recommend waiting for at least the RSI value. I assume you guys can see my charts. The RSI value to peak within the overbought range and exit, and form an exit. When I say exit, I mean drive back through the RSI overbought threshold of 70. So we're back into the 30-70 range here. Same goes for the RSI overbought signals. Yes, price jumped into this area here. As you can see, look, we jump into oversold at this area here, but look at what happens. Price you know, for lack of a better word, mucks around for a bit, right? And this could have stopped out a lot of traders. So we look for the RSI signal, RSI value to jump back into the what you would say the 30, 70. This is called, a lot of people call this no man's land. The point between 70 and 30, the purple shaded area. I hope that answers your question, Jim Watson. Is it, another question, is it similar to twin CC RSI? I'm not sure what that means. Could you please try and simplify the question if possible for me? Okay, another question. How long can a stock normally stay overbought and oversold? Alex, that's a really good question. And if I knew that question, I'd probably be a millionaire by now. The answer is no one knows. So in a trending market, in a strong trending market, the RSI can remain in overbought or oversold for prolonged periods of time. Look back on your chart, find the trending markets, and you'll see price can actually just continually, and that's the point of that's why I tend to ignore the RSI overbought and oversold signals, because even though, for instance, on the chart, even though price exits the overbought range, in a trending market, this could be a false signal. So what traders normally do in strong trending markets is form a support around I think it's between the 40 to 50 range, and that becomes the new oversold region, because the value generally does not pull back all the way to overbought. So traders use, I think it's about the 90 region for overbought signals within trending environments. So that's just something else to keep in mind. We have someone saying, I could not hear it. I could not hear the webinar. I hope you can hear it. I hope you can hear it now. I don't think anyone else was speaking about the volume or anything. So I apologize for that. Another question is, what is the RSI setting you use when trading based on your experience? Look, I always stick to the default periods of 14, which was set by Wilder. A lot of testing has been done on the 14 period setting. However, I do know of traders that use, shorter-term traders that use the 9 and 10 periods to increase the sensitivity of the indicator, so you get more overbought and oversold signals. And also, I know longer-term traders that also look at the higher periods to increase the sensitivity. But for me personally, I always stick to the, as you can see on the chart, I'll show you, always stick to the 14 period. And that's the same, that goes for the H1 time frame as well. Okay. Can the RSI correlate with volumes? It's a good question, Darren. It can, I believe it can. Yes, it can. I know it can. But as I'm sure you're aware, in the FX market, we're largely stuck with broker-fed volume, right? So you would have to go to the futures market, or if you're talking about stocks, you're fine because you can trade on the exchanges, right? So yes, I do believe volume does correlate with the RSI. I mean, commodity channel index, as the charts look very similar. Yes, they do look very similar, but I think from my experience, I don't have much experience with the commodity channel index, but I did study it during the CMT, and I think that includes more volatility. I personally prefer the RSI over any indicator I've looked at. The MACD is a close second, but I still prefer the RSI, as it produces, in my opinion, again, produces more valuable, reliable, should I say, signals. Okay, is 3070 the good range for intraday trade and FX market? I assume, again, you're talking about the oversold and overbought signals. As I said at the beginning of the webinar, the RSI can be used on all time frames. It's not just the daily time frame. So look, I believe it can. No, I know it can, because I know of a few intraday traders that incorporate the RSI with price action techniques. So for instance, let me give you an example. Let me just spin back to the charts just really quickly. Give you a clean example. Try and find a clean example, should I say? Right, okay, so I can't find one right now, but let me just try. See what the pound's up to. Pound made some good moves yesterday, didn't it? Okay, look, I don't really see much to show an example, but so what I'll do is so look, guys, a trader that I know very well, who was actually my mentor at the beginning of my career, more than a decade ago now, he traded a very basic method. One of his methods which was called his bread and butter, and this included the trend line support. Now, he was a master of finding trend line supports. So we have a trend. I assume you guys can see my dollar yen chart. I hope so, because I'm talking away here. So we have a clear-cut trend line support, and price reacted. Like, ignore the other confluence, but don't ignore it, obviously. But for this example, I mean, so imagine trend line support is tested, and we form bullish divergence. This was one of his bullish divergence within the overbought and oversold range. This was one of his key methods. So simply a trend line support with RSI divergence within oversold range. So for that question, is 30 and 70 a good range for intraday trading and FX market? I believe, as I said, I know that the RSI can be used on any time frame in the market. So yes, the answer to that question is yes. Again, it depends on your own personal strategy. However, okay, probably a bit of a no, Jim. So there's a question here. Do I know of any way to set up alerts on the failure patterns or divergence patterns? I know on TradingView, Jim, you can do that, and also on the MT4. I know you can do that because I used to use the MT4 regularly. You can use. There's plenty of what do they call them? I forgot the term now. The external the expert advisors, I believe. Yeah, expert advisors or scripts or something they're called. So you put them into the MT4, and you can set the alerts on the RSI for that to alert. Now the alerts, I believe, do send an email to your inbox, or they just make a sound, and yeah. So and that's, I just used the sound because I was always at the computer. So yeah, but on TradingView it's a lot easier, as I can demonstrate here. You can just simply, I think you can set the values. So look, I thought you could anyway. Yeah, you can. I know you can set the alerts on this system by just simply clicking the y-axis here. But yeah, the answer to that question, Jim, is yes. You can set alerts on your system. There's another. Show us example of use of RSI on ranging market. I haven't prepped for that. I'm sorry. So look, with time of the essence right now, I'm not going to be able to show you an example of that. But look, I can go over that in the next presentation if you would like me to. Right. So look, guys, I think that's all the questions. That's all the questions covered. Oh, okay. One more question, please. Is fib expansion tool on MT4 the same as the fib extension tool on TradingView? That's a very good question. So I assume you guys can see my charts. So the fib. So look, guys, you do know a fib extension tool is simply the Fibonacci retracement, and it's extended below how to explain this? I wasn't prepped for this. So look, this is the Fibonacci retracement tool. Yeah, let me just enlarge the chart. Okay, so we have the Fibonacci retracement tool here. So the extension, so a fib extension. So look, to answer your question, no, please, is the fib expansion tool on MT4 the same as fib extension on TradingView? The answer to that question is no, because they're two different things. So look, a fib extension is an extension of the retracement tool. It's not an extension of price movement in the direction of a trend. It's the extension of the retracement tool. So imagine price rallies up, comes back down, forms a retracement, misses all these fib retracement areas here, and then breaks the 100% mark that's normally here. This is when we're into extension territory. So it's an extension of the retracement values. Now, a fib expansion, if my memory serves me correct, a fib expansion is drawn from, let me just try and find an example for you guys. So a fib expansion is requires only 2 points. So I don't want to go too much into detail with this because this is a webinar on RSI. But so look, let me just draw a quick example for you. We have the price movement going up. Okay, so just think of this as an uptrend, a really rough uptrend. So an expansion, as you asked, I believe, let me just try and expand the questions there. So an expansion requires only 2 points. So imagine this point A to point B. So the expansion is this tool here, and we put it back to point A to point B, draw it back to point A, and this is your expansion levels. So don't confuse this with projection. So we have projection levels, which requires the 3 points. So ignore this, and we draw this to wrong point. Projection requires 3 points: A, B, and C. And you're projecting. So basically, you're projecting this wave from point C. So look. The fib expansion tool is definitely not the same as the fib extension tool on TradingView. I hope that answers your question, and I hope I haven't confused you too much. Guys, any more questions before I just round things off? Any more questions before I round things off? Looks like I've covered everything, I believe. Okay. So, guys, look, I know I've thrown quite a lot at you this session, but I sincerely hope at least some of the newer traders were able to walk away from this presentation with something to work with. As always, if you want to get in contact with the research team here at FP, feel free to send us an email at marketanalyst@fpmarkets.com. Also, if there are any specific time period, any specific topics you would like the team here to talk about, please be sure to send in your suggestions. However, I will just say, guys, in my last webinar, there was a lot of interest in the Quasimodo resistance and Quasimodo support levels. We do have a webinar I'll be conducting on the 24th of March, I believe. 24th of May, I believe. So please do consider signing up for that. I will go into detail in with that formation. Also, be sure to register for our next webinar on Fibonacci retracement strategies, which will be covered by Isaac, my colleague. Do also consider registering for the FP Markets Telegram channel to get instant updates, which can be found on the main FP website. Right, okay, one more. We have another question. So how do I use the extension tool on MT4? I don't actually have MT4 loaded on this platform. I apologize. Look, as I said, we have a presentation on Thursday. I believe it's Thursday with Isaac, and he's covering the Fibonacci retracement strategies. I would definitely encourage asking him, because I believe he is going to be using the MT4 or MT5 platform. Okay, so look, guys, as I said, thank you all for taking the time out of your day to attend this presentation. Again, I hope I haven't confused too many of you, and I hope you can take something. Hope you've taken something away from the webinar. Have a great day, and I'll see you all very soon. Thank you very much. Goodbye.